Imagine a world where your ability to secure a home depended entirely on the mood of the man sitting across from you at a heavy oak desk. Decades ago, securing capital was an intensely personal interaction. The local banker held immense subjective power, weighing your reputation, your family name, and his own prejudices before opening the vault. It was a financial system built entirely on subjective human judgment, where character was assessed through a handshake and community gossip. Today, that heavy oak desk has been replaced by a silent, invisible judge operating deep within the servers of the global economy. When you apply for a mortgage, a car lease, or even a basic credit card, no one looks you in the eye to measure your worth. Instead, a proprietary algorithm executes a rapid series of calculations, stripping away your humanity to produce a single, cold, three-digit number. This mathematical verdict dictates your economic future in milliseconds. The consequences of this unseen calculation ripple through every aspect of ordinary life. A difference of 50 points can mean the difference between securing a safe neighborhood for your children or being relegated to substandard housing. It can mean paying tens of thousands of dollars more in interest over the life of a loan, quietly draining your wealth to feed institutional profit margins. For millions, this digital shadow is a relentless gatekeeper, deciding who gets to participate in the modern economy and who is locked out. The foundation of this invisible architecture was laid in the mid-20th century by two men who believed human behavior could be tamed by mathematics. Engineer Bill Fair and mathematician Earl Isaac looked at the chaotic, prejudiced world of mid-century lending and saw a problem of massive inefficiency. They hypothesized that the likelihood of a borrower defaulting was not a mystery of the human soul, but a predictable outcome that could be modeled, tracked, and scored just like fluid dynamics or structural engineering. In 1956, they founded the Fair-Isaac Corporation, armed with an initial investment of just $400 and a radical vision. Their goal was to replace the flawed, biased intuition of the local loan officer with the cold, unyielding logic of statistical analysis. By gathering vast amounts of consumer payment histories, they began building a predictive engine. This marked a monumental shift in power, moving the authority to grant credit away from community institutions and into the hands of data scientists. At the time, the landscape of credit reporting was a fragmented, largely unregulated web of local bureaus. These agencies collected not just payment records, but newspaper clippings, rumors about drinking habits, and subjective notes on marital strife. It was a deeply flawed apparatus, rife with racial discrimination and arbitrary judgments. The founders of the new predictive model promised a cleaner, more objective future, where mathematics would blind the system to race, gender, and personal grudges. To achieve this, their algorithm ingested specific variables and assigned them weighted values. Your payment history became the heaviest anchor, followed closely by your credit utilization ratio, the length of your history, new credit inquiries, and the mix of accounts you held. By feeding these variables into their proprietary formula, they transformed the messy reality of a person's financial struggles and triumphs into a perfectly standardized, highly tradable metric of risk. The true revolution arrived in 1989, a watershed moment that permanently altered the global economic landscape. That year, the company introduced the first general-purpose FICO score, a standardized rating system designed to be used by any lender, anywhere. This release coincided with the rapid expansion of consumer debt and the dawn of computerized banking, creating the perfect environment for an algorithmic takeover. The banking industry embraced this new tool with ravenous enthusiasm. For massive financial institutions, the localized, relationship-based model of lending was a severe bottleneck to growth. The new three-digit metric allowed them to scale their operations infinitely, processing thousands of applications an hour without ever speaking to a human being. It was the ultimate mechanism for mass-market credit, prioritizing blinding speed and corporate efficiency over individual context. The dominance of this metric was cemented in the mid-1990s when government-backed mortgage titans Fannie Mae and Freddie Mac made a quiet but earth-shattering decision. They mandated the use of the FICO score for all mortgages they purchased, essentially writing the algorithm into the foundational code of the American housing market. Overnight, this private, proprietary mathematical model became an unofficial regulatory standard, possessing the power of federal law without the democratic oversight. For the average citizen, the personal trust that once defined financial relationships vanished entirely, replaced by a relentless demand for algorithmic compliance. You were no longer a hard-working individual who fell behind because of a medical emergency. You were simply a high-risk data point. The score became an inescapable financial passport. Without a high rating, you were subjected to predatory interest rates, trapping you in a cycle where borrowing was necessary to survive, but too expensive to ever escape. This created an unprecedented dynamic of unseen authority. The creators of the algorithm did not lend a single dollar of their own money, yet they had become the ultimate arbiters of global capital flow. They built a toll booth on the highway to the middle class. Every bank, every credit union, and every auto financier had to pay homage to this singular mathematical model, surrendering their own judgment to the dictates of a private corporation's closely guarded secret. The sheer opacity of this system remains one of its most powerful features. Because the exact formula is a protected trade secret, consumers are forced to navigate a maze of financial rules in the dark. We are told the general categories that affect our standing, but the precise internal weighting is hidden behind corporate firewalls. This asymmetry of information ensures that the borrower is always at a disadvantage, constantly guessing how their next financial move will be judged by the machine. While the system successfully eliminated the overt, face-to-face prejudice of the old local banker, it introduced a new, sterilized form of inequality. The algorithm is blind to race, but it is highly sensitive to historical wealth disparities. Because the formula relies on past credit behavior, it mathematically penalizes those who start with nothing. Generational poverty is encoded into the data, ensuring that those who have historically been denied access to wealth face the steepest mathematical hurdles to obtain it today. As the decades passed, the influence of this three-digit number breached the walls of the banking sector, infecting entirely unrelated industries. Insurance companies began using credit data to set premiums for auto and home policies, arguing that financial stress predicted physical recklessness. Landlords weaponized the score to screen tenants, and major corporations began running credit checks on job applicants. The metric of borrowing risk mutated into a universal measure of human reliability. The lived reality of this expansion is a pervasive, low-level anxiety that haunts millions of consumers. People find themselves engaging in bizarre financial gymnastics just to appease the algorithm. They leave unused credit cards open, meticulously time their debt payments before statement closing dates, and fearfully avoid closing old accounts. The pursuit of a higher rating has become a secondary job, a gamified struggle for survival where the rules are constantly shifting. The echoes of the old handshake-based era highlight exactly what was sacrificed on the altar of efficiency. When a local lender evaluated a borrower, they could factor in the narrative of a life, understanding a sudden layoff, a bitter divorce, or an unexpected hospitalization. The modern algorithmic ledger possesses no capacity for grace, mercy, or context. It only registers the missed payment, punishing the borrower precisely when they are at their most vulnerable. This relentless surveillance has fundamentally altered consumer psychology and behavior. We no longer make financial decisions based solely on what is best for our families or our immediate needs. Instead, we ask how a choice will impact our rating. The algorithm focuses our attention inward, forcing us to self-police our economic behavior to maintain our standing in a system we cannot control. We have internalized the gaze of the digital banker. The cruelty of this architecture lies in its self-fulfilling feedback loops. A low rating triggers higher interest rates, which consume a larger percentage of a borrower's income. This reduced cash flow makes it exponentially harder to pay down the principal debt, which in turn keeps the utilization ratio high and the score perpetually depressed. It is a perfectly engineered poverty trap, extracting maximum profit from those least able to afford it. Feeding this insatiable algorithm requires a massive, continuous harvest of personal information. Three dominant credit reporting bureaus, Equifax, Experian, and TransUnion, operate as an oligopoly of surveillance, quietly compiling billions of data points on consumer behavior every single day. They sweep up public records, utility payments, and credit card balances, packaging our financial lives into raw material to be processed, scored, and sold back to the banks. Despite the immense power wielded by this triopoly and the master algorithm they feed, meaningful regulatory oversight remains remarkably weak. When the massive databases contain errors, like a mixed file, a fraudulent account, or an incorrectly reported delinquency, the burden of proof falls entirely on the individual. Consumers must wage exhausting bureaucratic wars against faceless corporations just to prove their own innocence and reclaim their economic identity. We are left to confront a profound philosophical crisis at the heart of our economy. By outsourcing the distribution of capital to a mathematical model, we have created a highly efficient, infinitely scalable financial system that is entirely devoid of human empathy. We have traded the subjective biases of the past for the objective ruthlessness of the present, allowing a string of code to determine the limits of human potential. The ultimate triumph of this unseen architecture is how completely we have accepted it as a natural law of the universe. We celebrate a score of 800 as a moral victory and hide a score of 500 as a shameful secret. The system focuses our attention on a singular number, convincing us that our financial struggles are entirely our own fault, masking the broader macroeconomic forces of wage stagnation and inflation that actually drive us into debt. The invention of this predictive model did not merely streamline the loan process, it fundamentally rewrote the social contract. It transformed personal risk into a tradable commodity and human character into a sterile algorithmic data point. As long as this shadow ledger dictates the flow of global capital, our financial destinies will remain tethered to a proprietary equation, quietly judging us from the dark servers of an empire built on our own data.